Ladies and gentlemen, good morning and welcome to Aviva's Investor Update. Before we kick off, I'd just like to go through the customary slide on forward-looking statements. And now, I'd like to invite Maurice Tulloch, our Chief Executive, to commence the presentation.
Morning, everyone. It's an interesting day in history. Now, it's not because I got up at 4 a.m. to watch the end of the Toronto Raptors game. I know no one in this room is likely interested in the outcome of that game, but I will tell you the outcome of that game. They actually beat the Golden State Warriors, another name you've never heard of. So they're now up 2-1 in this series. If you'd like, I could talk about what I thought about Liverpool and their great victory on the weekend. But in all seriousness, June 6th, and I know you're here for the Aviva Capital Markets Day, but it does have some pretty important connotations in history. 75 years ago, we had the D-Day landing. That was comprised of British, U.S., and Canadian forces, and kind of it was the start of the end of the Second War. And 10,000 Allied forces approximately lost their life on that day. And I think what's important for us here at Aviva is we lost 12 members of the Aviva family that had taken time away from working for our company to go serve. And for that, we're forever ever hold our thanks with those individuals that lost their lives. How time flies. At our results in March, it was day four for me as Aviva's new chief executive. It's now day 94. Perhaps this is the perfect first 90 days. And the good news, I'm just as excited about our future as I was 3 months ago. Our organization has proven its resiliency and strength, and there are clear opportunities to drive better performance. That's what today is all about. Today I'm going to set out for you some of the changes I am making to drive a leaner, better Aviva. I'm going to talk about structure. I'm determined to crack Aviva's complexity, an issue that has held us back on our performance for far too long. I'll cover efficiency. Reducing Aviva's costs is essential to remaining competitive, and it's going to require some tough but necessary decisions. And I'll talk briefly about financials. We recognize the importance of income to our shareholders, and I am reiterating our dividend policy and also our debt reduction target. Now, what I won't be discussing today are the topics on the right-hand side of this slide. However, I can assure you considerable work is already underway. These topics, strategy, execution plans, and targets will be discussed in detail in November. So why have I structured this year's timetable and the communications in this way? Well, there are 3 key reasons. Firstly, to allow the time to do the thorough and necessary job on strategy. I had a good idea about my strategic priorities on March 4th when I took this job. I've developed my thinking further based on discussions with many of you and travels over the past 3 months. I will look at all options. There are no sacred cows. This is a comprehensive piece of work, and we need to take the time to get this right for the long term. Secondly, I wanted to spend the initial period meeting our stakeholders, staff, customers, and partners. This is time-consuming, but these groups are the lifeblood of our business, and our relationships are critically important for our success. Thirdly, I had strong views about some of the changes that we need to make to become a more effective organization focused on the fundamentals of insurance. Fundamentals aren't reliant on strategy, and it's important to get these changes underway, and this will be the focus of today's presentation. So before we examine the areas for improvement, I think it's important for all of us to have some perspective, taking a step back and looking at the big picture here. Aviva has some pretty solid foundations. We have restored financial strength, and sustainability. The capital position is strong at a 204% Solvency II ratio. We have $1.6 billion of center cash, and our dividend is well funded. We've made great progress on streamlining and strengthening our footprint. We pruned the businesses where we couldn't leverage scale or frankly did not have a distinct competitive advantage. And we've seen some decent broad-based performance here at Aviva. This is reflected in consistent growth in our operating earnings per share. The point is, we are steady and we are strong. But you know what? For me, steady and strong is nice. It's not good enough. We need to be lean, have strong lines of management accountability, and grow the company profitably. Our franchises have great potential. As I look across our major businesses, we have fundamental capabilities that give us opportunities to capture long-term organic growth. Our distribution is probably our most underappreciated strength. During my first 90 days, I've gone out and met, with our top 20 distributors around the world. They are not dinosaurs. They're not. And they know that Aviva is open for business. So why do I make that comment? Well, over 90% of our revenue comes through intermediaries around the world. And we have great distribution relationships. And this plays a critical role in serving customers and helping us earn attractive returns. Our technical skills are some of the best in the industry. We have a proven track record as a disciplined underwriter and risk manager. Part of the fundamentals that I'm pushing is that technical skills are not optional. They are essential to how Aviva will operate around the world. Our people who go above and beyond for our customers, when it matters most. And I've been out with them in Montreal during ice storms in the early 90s. I've sat with our life customer teams in Sheffield, and more recently in France, I've seen farms that are decimated by hail. And it's at times like these, when the worst happens, and our customers' lives are turned upside down, that our people really come into their own. So when I think about Aviva, there's so much more potential. For instance, in the UK Life, we are the market leader with a 17% share. We are number one in the workplace and have developed tools such as My Pension to capitalize on this channel. The movement of defined benefit assets off company balance sheets provides a long-term source for growth. And I personally think that the savings and retirement journey is one of the biggest challenges facing people today, and one of the biggest opportunities for insurers with the brand, the ingredients, the people, and the skill set for Aviva to play and win in that opportunity. In general insurance, we have a strong underwriting track record. We've overcome numerous industry challenges to maintain our combined operating ratio at between 94 and 97 since 2012. And we're exploiting growth opportunities now in a hardening commercial market. Europe is a great example of how focusing on the fundamentals drives better results. Across Europe, we focus on expanding distribution and optimizing. We focus on underwriting and launching innovative products. And we've managed our expenses pretty tightly as well. This has translated into higher growth in our European businesses. At Aviva Investors, we are investing to deliver strong investment management performance. That's critical. Enhancing our leading capabilities in real asset origination for Aviva and for third-party clients. And also growing our third-party funds, as evidenced by some recent large mandate wins in U.S. credit. Our Asian businesses are performing well and have lots of potential. In Singapore, we have more than replaced the DBS volumes and developed a strong business in the FA channel. Now, I'm the first to admit we haven't got everything right. In fact, I don't even think we're close to reaching our potential. But when you consider the heavy lifting that's already been done, now is not a bad time to be coming in as the new CEO of Aviva. So what do I think we can do to improve? Well, first of all, let's be clear. Even with that backdrop, I'm not going to sugarcoat anything. Our TSR has been poor. My job, my only job, is to deliver on what I believe is the untapped potential in this organization. So what can we do to improve? Well, there's three things that I want to tackle starting today. Complexity. Let's be honest. It's been an issue for Aviva for a long time, a very long time. And I am determined to resolve it, starting today. The management structure has not been clear, has not allowed leaders to be held accountable. This may seem small, but this is the essence of any well-run business, which has strong controls, a great focus on customer service, and clear lines of accountability. This complexity has both added to the cost base, but also not allowed for speed, pace, and delivery of efficient products and services to our customers. Efficiency. Pretty simple. When it's complex, it's hard to be efficient. It's really straightforward. We operate in extremely competitive markets. If we aren't competitive, customers won't choose us, and we shouldn't be in that market. This is about efficiency, but it also relates to CapEx. You know what? It's interesting at Aviva. I thought I knew most parts, didn't know everything. The past 12 months, we spent around £600 million, to be precise. But when I look at the expected benefits from this spend, I think our management of CapEx, both within business units and at the center, could have been better. You know, in all of my years, I've never seen a bad business case. Every one offers a great ROI, but there needs to be more commercial rigor, and that includes knowing when to stop or frankly just kill a project. Financials. It's important to address areas of concern that's been highlighted by investors and by many of you. Leverage. It's a topic debated by many of you in this room. We've made progress in taking leverage down. In fact, I think we've paid down $1.4 billion the last 3 years, and this has been recognized by the rating agencies. We are continuing to take action. Capital generation. This is of critical importance. We need to move in the right direction and make balanced choices about operating profit and OCG. Growth. This actually comes back again to the fundamentals. Insurance companies with the best fundamentals have stronger margins, earn more attractive returns, and deliver organic growth. So what am I going to do to deliver this improvement? Well, let me start first with my team. I think the first pillar of any successful group is the people that you surround yourself with. They need to bring the right skills and values to the table. I'm incredibly fortunate to have so many talented people here within Aviva. Our bench at Aviva is very strong, so we've been able to promote from within. As an example, you'll have seen yesterday's announcement that Jason Windsor will take over from Tom Stoddart on the 1st of July. Tom's been my colleague, my friend for the last 5 years, and has been one of the most important driving forces behind the balance sheet and cash flow improvements that you've seen. Thank you, Tom. He'll be handing over the baton to Jason, who knows this business inside and out, having led our M&A team, having led capital, and most recently as the CFO of our UK business. I've worked with Jason for almost a decade, and he's a person with incredible capabilities, knowledge of the capital markets and our businesses, and I look forward to working with him closely. Having previously announced management changes, I do want to draw to your attention some of the additional changes and nuance being announced today on the leadership team. Angela Darlington, supremely experienced in the UK life business, with a strong technical background, having previously been the group's chief risk officer. Colm Holmes, someone I hired 6 years ago, a 25-year industry veteran who has run our 2 largest general insurance businesses. I've shifted the composition of my senior leadership team. you will now see representation of people running businesses. This is intentional. The group center will be closer to the BUs. And we have good role alignment. The best general insurance people running GI. The best life people running life. Pretty simple. Makes sense, doesn't it? The next pillar is structure, the organizational design. When I talk about complexity, this is an important area to focus on. While we had streamlined our operations, we never properly adapted the size of the group center. And unfortunately, this has led to duplication and bureaucracy. We've talked about this for years and years and perhaps years, and it's never happened. Well, guess what? I'm moving to a lean group center, and I'm announcing that today. This will result in lower cost, which is useful, but it's just as important. It will empower business unit leaders, encourage them to take accountability, improve controls, allow them to focus on delivering great customer experience and strong financial results. Our European business is a great case study as to what can be achieved. If you go back 10 years ago, Aviva had 250 people in our European regional head office. 5 years ago, it had been reduced to 50 to 60. Our European business today has 5 people in a head office function. Now, I'm clearly not aiming at reducing the group center to 5 people. That would be foolish, as it provides a number of important functions relating to capital allocation, risk management, external stakeholder engagement. But we need to be ruthless in ensuring that we eradicate duplication, allowing responsibility and accountability for performance to reside primarily in our business units. While on the topic of structure, I think it's also important, I'm announcing some changes in the UK. The life and general insurance will be managed under separate leadership, and the UK digital direct business will move into our general insurance business. The obvious question is, why move back to separate leadership, given we only recently combined life and GI under Annie Briggs? When we put the businesses together, we had 2 main ambitions. Firstly, to encourage teams across different product segments to work closely together to serve customers more effectively and enable cross-sell. This worked well, particularly with our corporate customers, where we've seen some mandate wins across a number of products from existing customers. The second objective is to capture synergies from rationalizing technical and support functions, as you might expect in a merger. These benefits didn't materialize. The increase in complexity arguably had the opposite effect around service, around controls, around focus, around growth. Ended up spreading management too thin. Now, I appreciate how it looks, reversing moves from 2 years ago. You know what? It's not really a concern of mine. If something needs to be changed for the better, so be it. And you should expect that from me in my tenure as CEO of Aviva. I want to make Aviva a better business. And that's why I've made the decision to move back to an independent management structure. I want clearer management focus. I want both our life and GI businesses to be ambitious and focus on how they're going to win, be the best, rather than simply being the largest. Fundamentally, we shouldn't need the businesses to be managed together to cooperate for our customers. Part of the role of leadership team will be ensuring that we're able to bring the best of Aviva to our customers across different products. The other major change is digital. Let me tell you a bit more about that. So first of all, let me say from the outset, I'm not changing our commitment to digitize Aviva. I'm incredibly proud of what the digital teams have achieved. We have some phenomenal assets, right? And that still remains a key priority, but I'm changing the emphasis. It's now time to focus our attention on harvesting the benefits of those investments. For example, by moving UK Digital Direct into our general insurance business, I will have a single P&L owner with end-to-end accountability. Similarly, by taking our digital assets and using them in things such as our workplace business or with intermediaries in our respective businesses, we can improve productivity, customer experience, and spur organic growth. The increased focus on implementation and industrialization of our digital propositions does not mean that we're not going to invest in innovation. Of course we will. But as I said on March 7th, we have seen the high watermark for this investment, and I am demanding commercial rigor on investment spending across Aviva. What we will continue to invest in are initiatives that improve the user experience for customers and distributors and increase the cost effectiveness across the value chain. Now, the next slide is quite interesting. In the UK, our digital capabilities are recognized as the strongest in the market. Now, while the payback from digital has been longer than we expected, that does not detract from the fact that we have assets and propositions that have great support amongst our customers, and this positions us incredibly well for the future. Aviva, over 5 million active registered customers. Aviva Plus, it's only a recent product launch, but we're getting ahead of the market and offering a differentiated customer proposition, both in terms of loyalty and experience. Our digital business has been recognized by customers directly and through numerous industry awards. It is and will continue to be a very important part of our business, and I look forward to taking that to all of our customers. Let me turn now to expenses. Let me move the slide. Thank you. You will see from our results over the past 3 years, the operating expense ratio has actually increased. It's gone from 50% to 54%. Now, some of these expenses and spending were unavoidable, such as mandatory projects like GDPR and IFRS 17. And we've placed those costs, not placed those costs below the operating line. We've matched higher change spends in areas like IT modernization to longevity releases. This was a choice we made as IT modernization is a high priority that brings long-term benefits to Aviva. We've also invested in building additional capability in Asia and Aviva Investors, planting seeds for long-term growth. But this doesn't alter the fact our OPEX can be managed more tightly. And what am I doing about it? Well, today I'm announcing a cost reduction of £300 million by 2022, net of inflation at a constant FX. This means, quite simply, as you can see on the slide, our £4 billion cost base is expected to fall to £3.7 billion by 2022. How will this be delivered? I'm going hard at operational expenses. The head office is being streamlined. Consultancy and contractor spend will be reduced. Overheads are being managed across the group, and the BUs will also have to tighten their belt. We're also making significant savings in project expenditure. Some of this will be rapid completion of existing products, but I'll also be demanding more commercial rigor with the right structures in place to measure progress against the planned benefits. My goal is for Aviva to be leaner and develop a culture that is focused on continual improvement in efficiency and productivity. Let's turn to the financials. I'm going to cover this briefly today as it makes more sense for financials to flow from strategy at our November event, but I do want to outline some thoughts on a couple of important topics. You know, the two most frequent questions I've had from investors have been dividend affordability and leverage. Now, I know there's other debates like growth, perimeter, and earnings quality. We have made some commitments here today, a progressive dividend policy and a target to reduce debt by £1.5 billion. We stand by these commitments. I have gone over our plans and they are affordable. This slide looks at OCG relative to the dividend. OCG is a good anchor for cash. It's net of center costs and net of interest costs, and you can see that it has provided ample dividend capacity. We've grown our dividend consistently, right? We completed $2.3 billion of capital returns. And despite a tough investment market backdrop, we've actually added 24 points to our solvency cover ratio over the past 3 years. And we expect OCG to sustain our dividend in the future. Now, whilst you can see underlying OCG has fallen, in part because we increased investment in the business and expanded our appetite in capital-intensive product lines, which will deliver, for Aviva in the future, this has continued in the current year, but this investment should give rise to a stronger run rate of OCG looking forward, with cost reduction providing additional benefit. So we're focused on OCG moving in the right direction in the coming years, and you should also factor in the continuation of other capital actions, albeit at slightly lower levels than we've seen. So overall, capital generated is giving us the capacity to pay dividends and invest in the business. On cash, let me be even more explicit. Over the past 3 years, we've streamed £7.9 billion of cash. This funded center cost, dividends, and provided capacity for capital management. As we look forward over the next 3 years, our current plans indicate a comparable level of cash inflows to the group center. What I want you to take away from this is that our progressive dividend and debt reduction targets are well funded. We continue to manage cash at the center, ensuring the business has the capital to fund growth. Our strong central liquidity gives us the flexibility and also provides resiliency to short-term fluctuations. Finally, let me update you about trading and this year's results. Overall, the growth trends that we're seeing in 2018, the growth trends that we saw in 2018 are largely continuing in 2019. I better get my years right. Underlying growth is tracking at a similar level to 18. There is some variability, likely some one-offs, particularly in the first half of 19. But looking at the businesses, the positive trends continue across most of Europe and Asia, and the Canadian recovery is showing solid progress. BPA volumes year-to-date are below the record levels of H1 2018. However, our pipeline gives us confidence that we will deliver growth for the full year. Challenges are mostly in UK protection, where competition remains intense, and our savings businesses, including Aviva Investors, where revenues have been held back marginally by weaker investment markets and where we have continued to make investments in our business. On longevity, the 2018 CMI tables showed continued slowing of the longevity improvement. Work is still ongoing on the tables and should be completed in the second half of the year, hence my comment about H1 versus H2. In closing, I'm excited about the future. Despite what's been a tough macro backdrop, our organization has been resilient, and we have a solid baseline financially and operationally. This gives us optionality. There are clear opportunities for self-improvement, which can improve competitiveness, helping deliver better growth and better margins. And there's also strategic optionality. We are looking at all these options, and I will come back to you in November. Let me finish by giving you a sense of my priorities. We recognize the importance of our dividend to our shareholders. We are ambitious for the future, but we understand the importance of generating capital and cash to enable us to provide investors with an attractive and dependable income. We're going to open up things now for Q&A, but I'm going to ask Tom Stoddart to come up and say a few words.
Okay, we're going to run Q&A a little bit differently today. Ordinarily, I'd be up side by side here with Morris doing that, but given yesterday's news, I am a little bit of yesterday's news, and today is about the future, so we're going to hear a little bit more from Jason Windsor today. So But I want to be clear about this. I still am the Group Chief Financial Officer as of today and through the end of the year, through the end of the month. I'll be on garden leave then for the rest of the year. So if you've got questions for me directly, feel free to ask those. And if I think these guys need help, I reserve the right to come running back up on stage and amend their answers. So. But look, Jason is perfectly positioned to be my successor. He is the CFO currently of our UK insurance business, which is our biggest business by far and our most complex business. Before that, he's been our group Chief Capital and Investments Officer. And before that, he ran M&A and strategy and had financial planning and analysis reporting into him. So Morris is right. There's nobody that knows the group better than him, and I think he's going to do a great job here. So, Jason, let me offer you my personal congratulations and welcome to the stage.
Thank you. Thanks very much, Tom. Thanks
Morris, when you were talking about technical skills, you decoupled the technical skills, the fundamentals you talked about from the strategy. And I think you characterised the technical skills across the group as being good. Can you talk a little bit about the areas where you see a sort of gap to leader? You know, which bits have you looked at and thought, actually, there's not quite the edge I'd like to see on that front? And then secondly, on the distribution comments, it was interesting you said that 90% of the business is intermediated. I guess the criticism of the previous digital strategy was it focused on the 10% rather than 90%. If you look at the digital strategy going forward, you know, does it need to be more B2B or is it B2B2C? What's the sort of approach with digitizing an intermediated business? Thank you.
Great. Thanks, John. I'll take them. I'll take the second one first. It could take either one. Listen, I think in our digital business, we've done some amazing things. I mean, my Aviva got us into the game. Initially, we were a bit laggards, and I think now with how we sort of present, you know, all of the offerings of Aviva, we're actually leaders. The other thing that's happened in that area is certainly we have a function called Quantum, which is really 600 sort of data scientists, and that starts to move beyond kind of risk into sort of behavioral and sentiment analysis. In a perfect world, I would love all 33 of our million customers to deal directly with Aviva. That's not the reality. I'm a manufacturer, I'm channel agnostic. Customers decide if they want to come through a bank, through an IFA, through a broker, through an agent. So for me, the untapped potential is actually taking what we've built, and that's why I use the term harvesting. So I will definitely slow down the amount of innovation spend, because actually reskinning something from a D2C to a B2B2C, frankly, isn't 100 cents on the dollar. It's significantly less. And actually saying to those other partners, hey, we care. We want to deliver simple solutions that are convenient through different mediums to you, I think is terrific. The other thing is we kind of made them feel like they were second-class citizens. That was my kind of dinosaur point. You know, it's 90% today. In 5 years, is it going to be 85%? I don't know. It's still going to be the biggest part of our channel. So that is the harvesting thing, and I think that it's the one thing that Aviva is great at in all of our markets is distribution management. So I'm excited by that, and I know in talking to Chris, he's excited about that. I think your first question on the technical skills. This is a game of inches, insurance, right? And those game of inches may go down to a game of millimeters soon. I mean, we've got competition coming from everywhere, from new entrants. And quite frankly, if we're not finding out the best pricing algorithms, if we're not using AI to our advantage, if we're not understanding our exposure management, if we're not figuring out how with customers we can get fast, fair, efficient claim settlements, then we lose. And if I look at all of our markets or even all of our cells, I can tell you, I know the ones that are green and the ones that are red. So it's taking those fundamentals and saying, you know what binds Aviva together? What binds Aviva together is we're going to be great at insurance. We're not going to be embarrassed by that. And we'll also be great at customer experiences. So I think for that, there's an opportunity to increase lifetime value, actually probably lower lapses, to get growth, to increase margin. And I'm focused on taking that. I mean, our star is probably our UK general insurance business at the fundamentals. But even just taking that to our health business or taking it out to some of our savings or protection businesses is incremental. And the world we're in is a game of inches, and we've got to win. And I think we've got the capabilities to win. So thanks.
Colin Kelly, please.
Colin Kelly, UBS. Thanks for taking my questions. I'll focus on financials given the nature of the content today. In terms of the debt reduction target of 1.5 billion, obviously you have a lot of confidence in delivering that. Can you just give a little bit more detail on the funding of that? I think previously it was special dividends from subsidiaries. I know there's a capital to cash strategy ongoing to unlock some surplus in subsidiaries. But maybe you can give more detail on, where exactly that's coming from. Is it longevity releases or otherwise? Secondly, the operational capital generation is being put forward as a key metric here for the dividend, also in terms of generating cash flow for the holding company. Previously, I think it was growing, that was a mix of increasing the return on capital within business units, but also reallocating capital to the highest returning areas. In terms of the list provided today, it seems very focused on enhancing returns within the business units. Is that implying that capital reallocation across the group is a lower lever or less impactful lever within the targets? And then lastly, on the operational capital generation, you obviously have a clear commitment to grow this. What we've seen from companies thus far is those focused on capital intensive businesses have found it very difficult to simultaneously grow operational capital generation, be it in the short term or over a longer term. Those that have been successful in doing so are those that have focused on increasingly shifting towards capital light business. So do you believe that you have an ability to both grow OCG and also invest in capital intensive businesses, or is this more with a view of capital light in mind? Thank you.
All right, thanks, Tom. I'll take the first question. In the nature of answering that, I'll end up stumbling a bit into the second question, but I'll say to Jason, you can probably pick up what I missed in the second and certainly take the last question. So I think, first of all, I should take the comments that I made today kind of at face value. So we had 7.9 billion of cash over the last 3 years. I've looked at the plans, and they suggest it'll be a similar number. I think it's also worth noting we have a strong liquidity buffer. It was 1.6 billion at the full year, and really that operates as a shock absorber. OCG last year was about 1.5 billion. Remember that's net of center costs and finance and interest costs. So clearly covers the dividend, which is currently at 1.1. Your specific question is why are we confident, and what are some of the attributes that says we're still going to have specials, which ultimately, if you like, will fund the other capital actions, such as the 1.5 billion. I did say the specials will be lower going forward, but the next 3 years, we still have the benefit from previous M&A actions. That's about 500 million to come through. We are holding excess capital in our major business units, and we do have flows, coming from a business that was previously written. If you look at the last 3 years, effectively the specials covered what was 2.3 billion in capital actions. That was 900 million in a share buyback and 1.4 billion in debt. And the forecast that we've looked at gives us confidence to reiterate our commitment on the 1.5 billion in debt reduction over the next 3. And I've given you, a couple of those items. Do you want to talk about, I guess, growing OCG over time? And I guess the other one was sort of the capital intensity of our products.
Yeah, sure, thanks. So, look, capital generation and capital management is a key focus for us as a business. As you look at the growth in OCG, the general insurance business and the asset management business pretty much goes straight through, and obviously we're seeking to grow those. We've got a significant existing business which is contributing significantly to the OCG, and we can improve that with, as you say, with cost reduction and other sort of margin management. As it relates to new business, we really talk about a couple of areas. We don't spend an enormous amount on new business compared to sort of 10 years ago when I first came here. We've got about between 100 and 200 million of new business budget. That won't change dramatically. We've continued to grow the bulk annuity business across the period, about 20% last year, and we're indicating today we'll continue to grow it. But we're not going to be transformative in terms of the volumes in that business or in other lines that do require a little bit of capital, mainly in Europe. So we're going to continue to manage within a sensible budget to make sure that the plans, as we've set out today, are funded.
Oliver, please.
Oliver Steele, Deutsche Bank. 3 questions. First, can you just update us on the FPI sale? Second, it looks as if the larger part of costs from the, admittedly not to scale chart, are coming from the operational divisions, as it were. Looking at the way you show your group costs, the 4 billion, there's quite a lot that is sort of unexplained, either by life or non-life. So can you talk specifically about the sort of cost savings you're looking for within the life and the non-life divisions? And then the third question is, just going back to that management slide, is Colm head of all GI internationally, or just UK? And if he's only UK, what's happening elsewhere?
Okay, great. Thanks, Oliver. The conversations on FPIL are ongoing and constructive. And the second those are nearing completion, we'll certainly advise the markets. I think on respect to the cost, let me outline the process I went through. We're not giving specific clarity on functions, major product lines. The process I went through was not here is a 12% allocation and firing a letter out to every business and every function leader around the world. I looked at it and started from the perspective of our customers. And at the end of the day, those costs have to flow through into how we price our products. And I need to recognize that to win in a game of inches, in a retail consumer world, we needed to be competitive. So that was the basis, the process that we undertook. I think the one save and exception was I also wanted to tackle a cultural issue, the cultural issue of bureaucracy. So the lean group center probably had less to do with a specific target. Obviously, that is an overhead. But for me, that was a cultural barrier to enabling, Aviva to flourish, and for me to be able to have leaders that I could hold to account to deliver exceptional customer service and value for our shareholders. I've also looked specifically at the use of contractors and consultants. Those levels were far too high. So there will be, as I reduce those, there will be some people that obviously that I hire, albeit at a lower rate, and people that wear the team yellow shirt every day and don't come in and take our secrets and take them elsewhere. Clearly, I'm looking for greater rigor around CapEx. I mean, the 600 million is a daunting number, right? And the associated benefits with it were even more daunting, but I can tell you they haven't been materialized because the 600 wasn't managed that well. I'm not against making big investments, but they need to be well governed. I need to see the benefits come through for our business. And obviously then there's operational efficiencies in various businesses around the world. I think what you should expect is progress. We've said 4 billion to 3.7. Not planning on missing that. That's kind of credibility up here when you put those targets out. So we'll be updating on that every time we see. I think your last question was on the role of Colm Holmes. It's very similar, if not almost identical, to the role that I had when I was running the UK general insurance business. Colm is our CEO for general insurance business around the world. We will have a new Canadian CEO. That's actually being determined. I'm not going to announce it today because I kind of want Colm's Canadian, well, I guess they're mine too, Canadian employees to hear about that. So we're going to announce that tomorrow morning and give a chance for our staff to digest that. That individual will report directly into Colm. He will stay on the Canadian board. I think that's important for the continuity because we've got a rebound that's building. And he will set guidance and principles around the best way to run a GI business for our European businesses. Obviously, the legal line of authority is that with Patrick, who runs Europe. So that's the way I think about that role.
James Shook, please.
Thank you. It's James Shuck from Citi. 2 questions from me, please. Firstly, just around the cash remittances, the 7.9 billion number it's that you've seen in the last 3 years, that you also expect to meet over 19 to 21. That's a bigger number than I would have thought of. I can understand your reluctance to actually separate out the surplus capital that's being upstreamed from the underlying units, but if you could give any indication about the special elements of that would be helpful. But more importantly, I mean, the restriction for you guys actually doing things with your capital has really been cash flow up to now because you're in a surplus capital situation. What is the timeline for decision around deploying that cash? I know we have an update coming in November, but at that time, would you be able to look ahead with confidence because you've taken a step back from M&A, for example, and actually make a decision around whether share buybacks are something that you should be executing on now? Second question was just around the CapEx spend. So 600 million is obviously a big number. Could you just clarify for me how that is expensed through the P&L account? Is it included in its entirety in the 4 billion? And if you're able to categorize that into what that has been spent on so far, at least over that last 12-month period, I'd be interested to hear in the sorts of areas that it's gone to. Thank you.
Okay, thanks, James. Why don't we start with the first question, cash and the special remittance elements. Jason, I don't know if you can provide more color.
So there's no magic between some of the cash flows that we receive, but the fundamental setup of the group is that we think we've got enough operational capital generation and cash flow to pay the dividends, to pay the head office costs and interest costs. So that's the basis. And then I wouldn't hypothecate this directly, but you can think about it somewhat that the deleveraging can come from specials, as we look at that. So there's a bit of optionality around timing. We don't have debt, I think, as you know, to pay off today. So we'll be phasing it around, the choices that we have there across the board. But that probably understates it slightly, but there is opportunity around that in terms of timing and when we actually remit the cash up to group.
Your second question on the CapEx, and I don't have specifics. I'm going to have to give you, some flavor to it. So it doesn't all flow through. Some of it certainly sits on the balance sheet. I mean, in one sense, it is all a use of cash, whether it's gone through as accounting or not. Some of it will go through and be amortized over time. I mean, some of the bigger items are certainly, necessary investments that we've had to make in IT modernization. We've had to make investments in certainly cyber, as many companies have. We've had to make investments to comply with GDPR. But we've also had an awful lot of investments which are management decisions, such as product development, such as optimization of contact centers. We've made an awful lot into propositions. We've made an awful lot, and we alluded to it at the half year into digital, including now I'm signaling that that's the high watermark, and I want to see that harvested. We've made investments into leadership programs. And on the surface, none of them were originally bad decisions. I mean, they had great business cases, but they amounted to about 200 different projects. Very tough to be focused on running your business better when you've got 200 projects. And also, if I look at the benefits that they all derived, there was a significant gap from the original business cases to what was derived. So what I'm saying is it won't be that high going forward. That's probably about, if I go back 4 or 5 years without giving a specific number, well, I guess I'm going to give you a pretty specific number. It's probably in the range of 70% higher than it used to be. And I've got a business that really hasn't grown that much in the 4 years. So the ones that were mandatory that we had to do, fine, tick, I get that. But I can't run a business that, a scarce commodity like cash or capital is used, and I don't have the rigor around the returns. So I don't know if you want to say more about the accounting treatment specifically.
No, that number is a cash number that we spend. So there is some capitalisation. We don't do very much capitalisation across the. We tend to put it through as you would expect. We can probably give you a bit more colour on that in November.
Ashik, please.
Thank you. Ashik Musaddi from JP Morgan. Just a couple of questions. First of all, in terms of your 7.9 billion, which you're expecting again, more or less, does that include any disposals as well? Now, PRA is raising some issues with respect to model drift. So how do you think about this risk of model drift for UK life names, especially Aviva, and at the same time your expectation about special remittances? Would you not worry about that risk, or how should we think about that? Last one is with respect to cost. I mean, it looks like the cost base has gone up mainly in past 2 years. It was 3.6 billion in 2016. Now it's 4 billion. So would you say that the 300 million reduction that you're planning is a bit more back-end loaded, front-end loaded? Because these costs has just come like in past 2 years. So why would it take so much time to just get rid of that? I remember at the full year results as well, it was mentioned that the spend that you're doing, investment spend, is a bit more discretion as well. So why would it take like 2022 to realize these 300 million cost saving? That
Right.
would be a bit of help. Thank you.
Okay, great. Thank Ashik. I think I'll take question 1, question 3, and certainly model drift. I think I will leave to you, Jason. So, no, in the target for cash, it doesn't include any planned M&A. What is in there is previous M&A that we've done that still needs to be realized. So that's that. On question 3, so the 300 million is what I've looked at and the target that I've put forth. It did have the work actually started in November, so I inherited that and on March 4th and looked at that. We're signaling we'll probably spend about 300 million to realize those savings. We're expecting both the costs that we incur and the savings that we achieve to be linear. So don't expect a hockey stick that this is all coming in 2022. You should not expect the cost base for 2019 to go up. So the 4 billion is we're not going to front end load all the costs and back end load all the benefits. And think of this as a culture that we're starting. Right? I expect efficiency to be a key part of where we go forward from here. I can certainly tell you that's how I ran Europe. That's how I ran Canada previously, and that's how I previously ran UKGI. It's not optional. It's part of being great at insurance. You've got to be efficient. Do you want to talk about model drift?
So the first thing I would say is that we fundamentally believe in economic capital as the way to run the business. And the economic capital therefore requires a model, and there's some degree of subjectivity that goes into it. But if you do believe in economic capital, you are going to continue to try and optimize your business. You're trying to make judgments every day, and shorter and longer term, to improve the economic capital position of the business. You improve your return, you improve your cash flow, therefore. So model drift is a narrow way of thinking, are you sort of tweaking it slowly over time? I think what I would argue strongly is that we've been trying to optimize the position, we've been taking logical steps, and we rely heavily on our governance processes. We have a very strong second line process for reviewing the model. We have a very strong governance process for making sure that all goes through proper checks and balances, and we as first line and the regulator all rely on that, and we think we're in a very good place.
But it will not impact, you think, you're all right to still take out special remittances if it is from UK? Because expectation is
No, not at all. We don't see that right now as a risk that we need to take extra caution of. We're obviously, there are regulatory reviews that are ongoing, some of which are public, some of which are not, that we are factoring into our plans. That we hope that actually we can work those through, but they are actually factored in. Tom, do you want
a little bit here as well. We've seen the regulators been very active. So last year there was consultation around equity release mortgages, et cetera, and I think you'll continue to see that as a trend. But that's one of the things that we have to manage in business. So is regulatory impacts on capital a risk? Certainly, but it's one of the things that we need to manage on a day-to-day basis.
Thanks very much. It's Blair Stewart from Bank of America Merrill Lynch. 3 quick ones. Just coming back to the cash target, does that include an assumption for future longevity releases? You don't need to tell me how much, but does it? Secondly, what's your view on target liquidity at the centre? I think the previous messaging was that there was maybe $1 billion or so that was available now and ready to go. Has that message changed? Has your view on target liquidity changed? And thirdly, just coming back to the distribution point, I think your acquisition cost number overall running through the P&L is about as high as your operating cost. It's a big number in the billions. What's the view there in terms of efficiencies? Coming back to digital, selling direct, is there a chance to get that number down? Thank you.
Great, thanks, Blair. I think Jason, you should take question one. We could probably both take two, but why don't you tackle it and I'll tackle the distribution.
Such that there would be, yes, it would take into account any longevity assumption changes. On the liquidity, I don't think we're saying anything new today at the group. I think what we've said before, Tom, correct me if I'm wrong, is we would like to be between 1 and 2 billion. 2 would feel a bit high. 1 is a level. We could dip below that, but in a normal course, we want to be in that range, and that's the sort of the way that we manage the group, and that allows us the sort of ebbs and flows of dividends coming in, going out, and debt reductions across different periods.
And Blair, on distribution, I think it's a great point. We probably have another two plus on acquisition costs, billion across Aviva. Obviously, the biggest line item there is commissions, but you'd also have, marketing expenses, and we'd also have agency expenses. One of the principles when I talk about fundamentals is that of common pricing. So if someone wants to come buy something direct from Aviva, that should be absolutely our cheapest price. And if they come through our most expensive channel, let's say that's a bank insurance channel, then the cost of that acquisition actually has to go into the product price. I mean, our expected loss ratio doesn't change based on the nature and way a customer buys a product. So that acquisition cost should be fully passed on in our pricing. I suspect when we start going through and really ratcheting up the fundamentals, we'll find areas that cost we're not passing on. And I think that's important because then consumers determine value. They'll determine the value of intermediation in terms of advice, in terms of claims counseling, in terms of a lifetime journey if you're thinking about savings. But we need to ensure that the acquisition costs are properly reflected in that price to consumers. So I think it is an opportunity. But the angle I take is in common pricing, not necessarily reduction, albeit where we pay commissions higher than the market, or Aviva, we shouldn't have to do that.
So Greg and then Andrew, please.
Morning, Greg Pearson, KBW. I'll say 3 questions, of which the second one has got 2 parts.
So it's 4 questions, Greg, is it?
So just UK domestic motor, which is a sizable line. We've seen Allianz refinance Liverpool Victoria about 12 months ago and has now just ramped up its exposure, financial exposure to the UK. I believe in April we started to see them as being aggressive. I just wonder if you can give us a feeling for what the competitive environment in UK domestic motor has been in May.
Yeah.
And how Aviva Plus fits into that paradigm. Because I've also heard comments that you've started being more aggressive as well in your pricing. The second question, this is a 2-part one. I see you've shifted the emphasis from IFRS to OCG. Now, IFRS 1, in my view, is not fit for purpose, and we're going to get completely replaced by IFRS 17 in a few years' time. So, I mean, in the sense that shareholders are ultimately interested in economic value generation, what are you going to use to measure that? What are you going to link, what are the investors in their minds to? And then the second part is, well, then what is management remuneration, middle and senior management going to be linked to? And then in the final one is you spoke about tightening up the criteria for investment in CapEx. I was wondering, is that going to be an IRR type paradigm? And what is the IRR moving from? What was it before your hurdle rate, and what is it moving to now? Thank you.
Okay, great. Thanks, Greg. I will hand the second question to Jason. I will take parts of the first. There was definitely a few parts there. And I'll talk a bit about sort of the CapEx. So let me start with the first. I actually wish in one sense this was a results state, either full year or interim, because I could probably refer to you an awful lot of detailed numbers, but this is an investor day, and as such, I probably can't give you specifics, but let me at least give you some color. The UK motor market, right now is competitive. But actually, the positive light is it's starting to show some signs of some rate hardening, and we've seen that. And certainly, you're seeing interest from others. The advantage that we have in that market is really our route to market, and we play across every single channel. We arguably have the most efficient point to market with Quote Me Happy, which lives in the aggregator space. we have strong partnerships and we have strong brokers. And I think the Aviva Plus comment, that was as much about a potential growth vehicle as it was to tackle the problem, of the sort of new business incentivization, which, goes kind of contrary to most markets in the world where actually loyalty matters. It's early days. We're on plan to slightly ahead of plan currently in take-up, and it's certainly something that we want to offer to all of our customers. So, and then the other point was, what do I think about, Allianz, I think was the third parter in the first question. It's a competitive market. We're the number one player. If I look at our top line in UKGI, it's done okay, but it hasn't grown to my satisfaction. And when you have our brand and our technical skills and our distribution, I would be expecting to gain market share year on year. I guess the exception if the market's horrendous and margins are, eroding, then obviously you put the brakes on. But in most markets, I think the capabilities and data skills and customer skills we have should lead to that. Did you want to comment on the second question?
As it relates to how we measure value, we are in the insurance business, we're looking at return on capital. I was talking earlier about economic capital. That makes it somewhat challenging to cascade that down through all of the businesses, but our fundamental approach, we call it economic value added, and we sit on top of the capital base, and we allocate that to making all our key decisions. So whether that's pricing or projects or performance management, each one of those we try and allocate an amount of capital over the lifetime of the product or the project, and we say how much return are we going to get out of that, and we continue to try and drive that thinking into the business, and that turns it into capital generation and cash over time. That's.
But it's an OCG, it's a free cash flow type.
It's the capital generation adjusted for the amount of capital required for that particular product or project. And that forms part of your second part of your question, part of the incentivization, which we've got a balanced approach to that. We have a balanced scorecard, we've got financial, we've got custom, and we've got risk indicators. So we make sure that we look at the whole and the way that anybody gets rewarded. You have to balance the way that you achieve it. Of the financial ones, capital generation and cash remittances are very much on everybody's mind. IFRS is only part of it.
Greg, when we look at project spend, so first of all, it's a scarce resource, right? It's ultimately shareholder money. We look across a number of dimensions. So, does it improve our proposition for customers? Does it simplify, our relationship with customers, which ultimately leads to increased long-term value? Does it enable us to enter a new segment and grow our business? Does it allow us to increase our margins, or is it mandatory? And some of them are mandatory. So specifically, you wanted to know about IRR. I'm not going to give you a specific target, but I'm going to give you some pretty decent guidance. If you look at Aviva over the last few years, our return on capital has kind of ranged between sort of 11 and 13%. So strip out the mandatory projects. For me to allocate capital, it's certainly better be accretive to what we're currently looking at in terms of our cost or our previous returns. I think the more important point I was trying to make, that kind of gets you to gate one, gets you into the game. The more important point is then how we manage it and the rigor around that, because actually what I'm saying is, if I look at the 600, they were all wonderful business cases, but hindsight's a beautiful thing. Not nearly enough delivered on those business cases.
Andrew Green, please.
Good morning. I had 2 points of clarification and one question. On clarification, you say year-to-date trading is broadly consistent with 2018. Is that a euphemism for flat? Second point of clarification, there's a lot of questions around the 2019 to 21 cash remittances relative to the other, with you saying that management actions are coming down, M&A proceeds are roughly similar. So could you give us a bit more clarity either now or at another time in how much you're expecting to come up from France, including the proceeds of Antarius and the benefits you're baking in from the longevity releases? And then the question, of your 300 million cost savings, I noticed your project spend was 80 million last year, which is 50 million above any other year it's been in the last 7. So I was just wondering whether one could ascribe, you could ascribe 50 million of the 300 million cost savings just to bringing that back in line with long-term averages.
Okay. Let me take the first question. I'll hand you the second too. You probably got to look up detail on the third one. Listen, I mean, thank you for the first one, because clearly I probably didn't say an adjective that I should have said. What I meant to say, if I didn't say it correctly, is growth in 2019 is broadly consistent with growth in 2018. Now we've got, lots of pluses and minuses. Europe is trading well. The Canadian recovery is strengthening. Asia's trading well. Our UK businesses are doing quite well. Obviously, protection is challenging market conditions. The other point that I made is the longevity release. So last year we actually released some in H1. We're not planning on releasing anything in H1 this year, so there's a bit of a timing difference. But certainly our full year outlook is pretty consistent, and the work's underway with the 2018 tables, which pointed to continued slowing.
And would that be EPS or operating profit?
Yes, EPS. Do you want to tackle the second? Sorry.
Just a comment. I don't want anybody to read that too specifically as saying that EPS this year is going to be exactly the same as what it was last year in terms of a growth rate. I think you're trying to give more general guidance that rates of growth are comparable to what we saw last year, but it's still early in the year.
Correct.
At the full year, we gave guidance that because of Brexit and other macroeconomic uncertainty, there were risks to earnings this year. We've seen some of that materialize just in terms of lower investment markets generally, but we've got other things that are offsetting that. Meanwhile, Brexit has been postponed later in the year, so there still is uncertainty. So I just wouldn't want anybody to pencil in earnings EPS growth for 2019 to be identical to what it was last year.
Yeah, thanks, Tom. That's a good point.
Yeah, so on the project spend, the number you picked up, I think, Andrew, I just took a glance at the report, is it just in the group, not in the group wide, if I can use that term, group wide, sometimes we mean the head office. So that was 80 million, that's right. There is approximately 500 million also within the business units, and that's the 600 in total that we are referring to. And that's obviously going to contribute to the cost reduction over time.
Remind us again, Andrew, on the third one.
Sorry, it was about the
France.
cash remittances over 3 years, just giving clarity around France, both Antares and other stuff, and then also the longevity impact.
Okay, so historically, remind me if I'm wrong, Antares closed in 2017. I think that was part of the French business. It didn't actually get remitted to group and was part of the capitalization. So we haven't highlighted it, unlike the Spanish business, which was owned by group and was sold by group. So France has got some excess capital and has taken steps in the last couple of years to improve its capital position, and that's factored in to the forecast. But there's no actual other disposal proceeds or anything further coming out of France. As I said earlier to Blair, I think, any longevity that we would seek to adjust for is factored into the cash forecast that we have.
Gordon Aiken, please.
Yeah, thanks. Gordon Aiken from RBC. A couple of questions and an observation. First, we've had the largest ever bulk annuity announced today. Why was that not announced by you? And maybe talk a bit about case size, price, and ability to source the assets. Second, on costs, so you've got 300 million per annum cost saves. You've said the cost to achieve those would be roughly 300 million. Now, you've held back 1.5 billion of mortality gains in 17 and 18 cumulative, and you said you used that for IT. How are you going to put to work the residual, if we call it 1.2 billion, which now still sits in your expense reserve? And the observation third, just on cash, you mentioned the cash targets are inclusive of any mortality gains. Just running the numbers on your sensitivities, when you move to the 18 tables, which you'll do presumably this year, that's a 1.5 billion release, certainly that we expect. Doesn't that make your cash target altogether easier?
Okay, Thanks, Gordon. I'll maybe take the first one. We also want to talk about the mortality we've held back and the cost. You might have to remind me on the exact nuance on the cost, the question, unless you got it, Jason.
I might be able to have a go.
Okay. Listen, it's tough for us to comment on a competitor and a recent win. I think what we did say on BPAs was, quite frankly, the volume was slightly below our at present the record half year we had last year, but we remain, committed to our full year target, and we expect we might see some growth. I think the caveat there, what we've always said on bulks, is we've got pretty specific guardrails. So we'll look at the financial terms and conditions and take that against the backdrop. If we have excess capital as we do, and we think we can get suitable, adequate returns, then it makes sense. But I can't comment specifically on, I think it was Rolls-Royce, whether Aviva was in a process or not. Did you want to take the second question? I think I might have to hear the nuance around cost again.
I think, I'm not quite sure the expense reserve point, but as it relates to longevity, I mean, what we've released. We haven't kept that in any particular reserve. That's come through both to capital and to profit in 2018, so there's nothing in it separately reserved. As we look forward, in its CMI 18, I don't think it will be anything like the magnitude you've just put down. I won't say what it is, but we've done some preliminary work. We do expect to release, but it's not at that level, and we will see how that plays out. We're obviously thoughtful about that, around mapping that to our own book, mapping it to socio-economic trends, mapping it to sort of future, and looking at experience as well. So that work, as Maurice said, is underway. We go through that once a year, typically in Q3, and we would update as part of the results next year on that, and that's an annual process. I think I've had to make a comment on the BPA. Sure. I think we've been very pleased with how our BPA business has developed over the last 3 years. We've gone from a very low position writing. I think as you're aware, many smaller BPAs and sort of values in the 500 million a year type, and we've found the team, the asset processors, and the reinsurance to allow us to write bigger deals. And that's allowed us to write 2.6 billion last year. But we've long thought that BPA should be part of our UK Life business, but not our UK Life business shouldn't be solely focused on it. So we manage the volume in that context.
Gordon, was there another question that we may have both missed?
No, it was just, my recollection was from the full year results earlier this year that you'd said that mortality gain would, as per last year, be used for IT.
Okay, that would have been.
Just comment that we've looked at the longevity that we've seen coming out of the business, and we've been expecting to come out of the business as additional profit that has effectively allowed us to finance strategic investments in IT modernization. So the amount of longevity is a larger number, but it's provided us just a little bit more affordability for some of the modernization spending that we've been doing.
Hi, Dom Imani from Exane BNP Paribas. Sounds like you're going to be pretty busy over the next few years. I've got lots of questions, but I thought I might start with a few on the cost saving, if that's all right.
Sure.
If you allow for a bit of inflation, your 300 is more like 600 to 700 million order of magnitude in terms of saving. So that's about 15%. So it's a big target. You're only looking to reduce the roles by about 1,800. So clearly most of that spend is not personnel costs or not, own employee personnel costs. If you exclude personnel costs from the cost base, then a sort of 15% cost reduction it's much bigger. Guessing 25+% of that non-personnel cost, which is big. And I'm just curious as to understand what that is, and indeed how you're going to do that without having a knock-on effect in terms of ability to support growth. Second question. The expense numbers are all operating numbers, which makes sense. I'm just curious about where costs might land outside of that. So if I look at group amortization, for instance, over the last few years, that has grown. Is there going to be an amortization surge if, for example, there is a digitization part of the cost reduction program? And if that is capitalized, Jason, I realize you, as you said, you don't capitalize too much, but if there is capitalization going forwards, it would be helpful to understand the profile. And third, this may just expose my ignorance on the accounting, but as I understand it, under both IFRS and solvency, you capitalise a lot of expense for life in particular. So given that the 4 billion is not quite, as I understand it, not quite on the like-for-like basis, does that mean that actually some of the cost reduction will have a sort of a one-off lumpy effect? And is that actually fueling some of the special cash that we're likely to see? Thank you.
Great. Thank you for that. Let me start with one part of two, and then certainly I'll give you number three, and you can add to our accounting policies around amortization. I think here's the way I look at it. So sometimes history is your best guide. So it's only 3.5, 4 years ago that our cost base was 3.4 billion. It's now 4 billion. And if you look at our growth, you'd probably remind me pretty quickly we haven't grown that much. So we managed Aviva quite finely at a number actually less than the target I've set. I think we footnoted the inflation assumptions 1.8%, so the gross is probably closer to 500 million, and we have sort of said at constant FX. So that's just sort of the maths. Then I have to look at my game of inches. Am I competitive and am I winning? So if I look at my cost-income ratio and I look at it against my peer groups, and there's actually one of you out there that did the work, and I'm happy to read your little release about the day after I started. Our cost-income ratio has grown to 54%. Our peer group's at 47%. So we weren't competitive. Now, where is it coming from? And you're working ahead on the roles. What I didn't give you specifics on was how many contractors I have. It's pretty sizable. I didn't give you specifics on how much I spend on consultants. It's pretty sizable. If you look at the project spend, at roughly a cash outlay of 600 million, and I did actually say that's about 70% higher than what it was just 4 years ago, and I also said it didn't deliver nearly the value. So that's a big nut to go after, before, and I recognize there's some people tied to that, but there isn't, it doesn't have the direct effect. I think you should also take away from things like me saying I'm going to a lean group center that, if you were to look at roles and see where they come from in the organization, there will be a bias to management roles, which are obviously more costly and deliver more benefits. So we've done the work. We're really comfortable. It's the start. We will deliver, and it's not going to be a hockey stick. And probably every time that we see you, we'll be giving an update on it. Now, in terms of the amortization, maybe I won't answer that one.
Let me have a go.
I'm an accountant, but it's been a lot of years, so why don't you jump in?
Okay, so the first part I'll answer is the last point that you made around life maintenance expenses. So what we do, because we've got the contracts on the books, we make an assumption as to what is the cost of running that contract until its maturity, and that feeds through to the value of the liabilities. And obviously if we had lower expenses, which would be a natural corollary of a cost reduction exercise, you would expect that the liability to go down and hence your profit to come up. And that, you've seen that at various times when we've moved our expense assumptions, and we test that as like all of our assumptions every year. Only a relatively small part of the 300 will be life maintenance expenses. You've got non-life, asset management, head office, projects, and the like. So part of it, yes, you're absolutely right. The other part of it is the amortization of project spend. Some of that overlaps a little bit with what I just said, but we're not expecting a big write-off of existing projects or the like. So we'd expect that to sort of continue, but get smaller over time. The costs of that as we look forward.
Ming Zhu from Panmure Gordon. 3 questions, please. Your cost saving target is over 3 years. At what point on the timeline that if things does not go as the way you decide, and you might have to take more radical changes, such as dispose certain units of the business? And my second question is your cost saving, 300 million per annum, and the 300 million to deliver that. How much of that exactly translate to OCG level and cash remittance? And my third question is your asset management. Could you please share your plans and in terms of what you would, is any plans to make that contribution more, because it was about 5% of your operating earnings in 2018. Is there a target there? You might want to increase that proportion.
Okay, thanks, Minjo. I'll take the first question, Jason, how it translates into OCG, and how does it come over time? And we can probably both tackle the asset management, and we've also got you in here, should we want to say a bit more. And obviously we'll give an awful lot more detail on the various component parts of Aviva at our interim results. So I think the first thing, listen, the cost savings have nothing to do with dividend affordability. Our dividend is well covered by our current OCG, and Jason talked about how we're looking to improve the OCG. It's obviously a nice benefit as it flows through. Cost savings have to be about being competitive, right? They have to be about being able to win in our chosen markets, so that ultimately the product that we charge our consumers is effective. I mean, a big, huge swath of what we do is retail financial services. Let me comment, just while I'm still talking, I'll comment on asset management. You may want to add some color, and then you can kind of go to how does this flow?
So sort of a bit of a build on my previous answer. So costs in head office, asset management, non-life insurance, as they fall through the P&L, pretty much go directly to OCG, and for life new business, it's pretty much one for one. And then the life maintenance expenses is the answer I just gave to Dom. That feeds through. And then as we spend, obviously, the money to achieve those savings, which will be spread out over the next 2.5 years or so, that will be a cost, certainly to the cash flow. So most of the cash flow benefits will be post 2021. There'll be some, building up over 20 and 2021, but as we're looking at the clean air from 2022 onwards.
Our asset management business is integral to Aviva. Manages 330 billion of sterling of AUM. They really have sort of three key priorities. One's clearly investment performance for our policyholder funds and also our shareholder funds. They're also critical to our UK life business. So what they do in terms of what the skills and the talent that we've built in real asset origination is critical, particularly when we're talking about the BPA market. And that's just not for Aviva, that's also for third parties. And it's also critical that we take those skills and capabilities and attract more third-party funds. And certainly, we started with Ames when Ewan came here, but now we have a great U.S. credit business. And we've recently won a couple of large mandates, into the billions, and we can't comment specifically on them today. We will in terms of the more details when we are able to make public statements. But it's part of Aviva. Certainly I'd like to see it prosper and flourish, just like I'd like to see all parts of Aviva.
We'll complete the Q&A there. Maurice, would you like to close the presentation, please?
I would just like to say to everyone, thank you for taking the time. This is, the start of the journey. I took this job to effectively get Aviva to where I think it should be. After 26 years, I've seen basically every single component part of this organization, and there's some tremendous people, some tremendous capabilities, and some tremendous opportunities. What I said to you on March 4th is I'd come to you and I'd talk about a few things. I would talk about efficiency. I would talk about people and structure. I would talk about bureaucracy. I would give confidence to the things that mattered most to you around dividend and honoring our previous commitments. I know there's a bit of a long legacy with new CEOs and changing targets, and I didn't want to get off on that foot. But I think also importantly, I said to you that I'm going to take the time to come back and look at our strategy and look at our targets. And I'd hope you'll judge me by, what myself and the team have done in the first 94 days. I know there's a little bit of impatience for November, but it'll come soon enough. And I think you should expect the same sort of kind of clear talk and specifics. I think you'll also see that what I've set out today, between now and the interims, and certainly between now and November, I will have delivered, and that process of delivery will be underway on what we've said today. So thank you very much.